Huntsville is growing fast. Aerospace, defense, tech, and the financing questions are growing right along with it. Veronetta Johnson has been mapping the terrain, and today we're following her through it.
We're covering two connected territories: how to decide whether FHA financing actually fits your situation, and what zero-down USDA homeownership really costs once you look past the headline. Let's start with the FHA decision. The real question with FHA loans isn't whether they're accessible. They clearly are. It's whether accessible means right for you. The post on FHA loans in Huntsville lays out both sides of that equation.
And it's direct about the tension. The post puts it plainly. The best mortgage is not necessarily the one requiring the smallest down payment. It is the one that creates sustainable homeownership while supporting long-term financial stability.
That reframes the whole conversation. A 3.5% down payment gets you in the door, but mortgage insurance premiums, both upfront and ongoing, can follow you for the life of the loan depending on your terms.
Which is the part the headline never mentions. The assumability feature is the quiet sleeper benefit here. A future buyer inheriting your lower rate in a high-rate market is genuinely useful.
The post also flags that FHA property standards can complicate offers in competitive markets. Roofing issues, lead paint, foundation concerns, any of those can stall or kill a transaction if a seller won't make repairs. And for military families specifically, the post draws a direct comparison to VA loans, which eliminate the down payment requirement and skip monthly mortgage insurance entirely.
So FHA is a door, not necessarily the best door. Depends entirely on who's walking through it.
Exactly. And for buyers looking at communities outside city limits, USDA financing enters the picture too, which is where the next post picks up.
Zero down sounds like the whole problem is solved. The USDA post on hidden challenges exists specifically to complicate that assumption.
The post is unambiguous on this point. While zero down payment programs have helped thousands of buyers become homeowners, they also come with requirements, responsibilities, and challenges that many first-time buyers never hear about until they are deep into the buying process. So the upshot is that zero down doesn't mean zero cost. Inspections, appraisals, title services, prepaid taxes, insurance, those expenses exist regardless of your loan type.
And USDA eligibility isn't just outside the city. The property has to fall within a federally designated area, and household income limits apply. Two filters that can quietly disqualify buyers who assumed they'd qualify automatically. Credit history matters too. The post is careful to say the truth falls somewhere in between perfect credit and credit being irrelevant. Lenders still examine payment history, debt levels, and employment consistency. The maintenance fund point is the one that sticks with me. Budgeting only for the mortgage payment and then meeting your first HVAC failure is a rough introduction to ownership.
And the post connects zero down programs to long-term wealth building. Equity grows over time, and that foundation can eventually support investment properties down the road.
Both posts land on the same idea from different angles. The financing tool matters less than understanding what it actually costs and what it's actually for.
Huntsville's market keeps growing, and so does the complexity. Next time, more from that landscape.